Hello and welcome to this week's special presentation. My name is Jim Penna, Manager of Retirement Services here at VectorVest, and I'm very happy to be hosting this week's topic, which is titled, The 3 Most Effective Strategies to Achieve Your Retirement Goals. Now, before I start, I want to keep this thought in mind. A wise man once said, a goal without a plan is just a wish. Now, knowing where you are now and where you want to go is a start. But without a defined plan in place to get there, the wish is all you are left with. Now, we all have dreams of personal and professional achievements that we would love to reach one day, but too often they remain just out of our grasp because we fail to create a plan or process that will get us there. This is where the disconnect between your wishes and goals occurs. So how about this as a goal to set for yourself? By taking control of your retirement, you can build your wealth, transform your legacy, and live financially free. Now, my goal in this presentation is to show you that you can achieve your goals when the proper plan is in place. I know you probably get flooded with emails promising to help your retirement, and probably and understandably you're skeptical and you're thinking, prove it. Well, we've been doing this a long time here at VectorVest. VectorVest started back in 1988, and for literally decades we've been using the power of VectorVest to help our investors using the stock analysis and market timing system that is so powerful. And so we've been able to build investment plans like these. Here are a couple of investment portfolios we have built and now manage with our retirement coaching group members every Tuesday. So in this growth portfolio, the goal here was capital appreciation, and it has tripled in just under 5 years, just about 5 years at 214%, using good quality, high relative safety stocks. That's over 45% annualized rate of return. And here I have a dividend growth portfolio. This equity curve shows just the capital appreciation of a quality dividend portfolio. If you go ahead and add another $50,000 in dividends that we've accumulated, right, you would add that right to this $188,000 that we're up already. Okay, and that doesn't include the power of compounding or reinvesting those dividends. So just some quick examples of how you can see that with proper planning comes superior results. So begin by asking yourself this question: are you in control of your retirement portfolio? Let's look at it this way. You're not in control if you're worried about the next market collapse wiping away a good chunk of your nest egg, and it's causing you to be so conservative and so afraid to invest in the market that you're not getting the gains that others are getting. You are not in control if you want to grow your account steadily each year, but it seems like every time you buy something or put some positions into your account, the market or your stock drops and your portfolio goes nowhere. In other words, you're just spinning your wheels. And also, you're not in control if you don't have an income source that is steady and it's causing you to scale back your lifestyle and not do the things that you want to do. And finally, you may be one of the many people who are over 65 who still have to work, not because you want to, because you must. So let me ask, does any of that ring true to you? As I said earlier, we've been doing this a long time here at VectorVest. We have determined that those scenarios I just went through are simply the symptoms of the core problem. And that problem is that your retirement investing model is broken. And all it takes is a few minor tweaks and you can get it fixed. And once it's fixed, the portion of your net worth allocated to the equity markets will be on solid footing. And that's what we're going to do in this presentation. The model we use and have proven to work is what we call VectorVest's 3 Ps investing model. And those 3 Ps are profit, provide, and preserve. So when you think of profit, you can also think of the word growth or capital appreciation. So profit is a plan to grow your portfolio safely and steadily each year. When you think of provide, think of providing income, right? It's simply a system to generate consistent income. And when you think of preserve, also think of the word protect, right? Preserve is a protection plan for your capital preservation. When put together, it leads us to our goals. So if you want to achieve the goals of building wealth, transforming your legacy, and living financially free, you need to grow your investments, generate income, and protect your capital. When you do all 3, that's when you'll have your financial freedom. The first shift you need to make to do this is to shift from not being in control of your own retirement to where you decide to take control of your retirement. After all, who cares more for your money, you or someone else? You might think you don't have the time or the knowledge or the skill to do this, but you're going to see that you can do it, that it doesn't take a lot of time. It does takes some time, some effort to be put in here, but you also have the knowledge at your fingertips here with VectorVest to be able to implement and apply these plans. So I'm going to start with preserve. The first P that I want to talk about, in my opinion and in my experience, is the most important part of this, of the three Ps. Right? The first thing you need to do is protect your assets. Right? I'm using preserve first because it's important to understand the concept that you cannot grow your capital if you don't know how to preserve and protect it. So instead of worrying about the next market collapse wiping away your nest egg, you need to have a strategic defense system in place to protect your assets. So how can we be prepared for the next market collapse? Well, it comes from proper market guidance. So I'm going to take a couple of minutes here and talk about looking back at the market and how you can recognize trends in the market to protect yourself against these market collapses. So here's a look at the market timing graph. This is the VectorVest composite. It goes all the way back to 1999. Now I know you probably have owned good quality stocks and watched them drop when the market dropped, right? We've all been there. So let's zoom in on a few of the biggest market moves that really hurt a lot of folks over the last 20 years or so. Now, many of you may have been invested in companies and managing your portfolio when the bursting of the dot-com bubble occurred. Right? During the dot-com boom, a lot of investors were able to grow their portfolios many times over. However, in 2000, most lost almost everything over the next 2 years. And that happens way too much. You make money during the uptrend. And if you don't know how to protect it, you give it all back and you can spend years trying to recover those losses. Right here in 2008, during the housing bubble burst, the average mutual fund dropped over 40%. And again, many people lost 30, 40, 50% of their retirement nest egg. And just last year, before the pandemic sell-off, the S&P 500 dropped 34%. Now, this was a much quicker fall and a quicker recovery. But I'm curious as to how many of you who are listening had your financial advisor or money manager call you leading up to any of these events to warn you. And there are many others. I'm focusing on the three main ones here. I doubt that you had many phone calls over that period telling you how to be strategically defensive in your portfolio. Okay, which brings us to today. Many are worried about the next market collapse. Some people say that you can't time the market. Well, they can't because they don't know how, or they don't understand the concept. The fact is, you can't predict the market, right? But you can recognize short, intermediate, and longer-term trends that greatly enhance the probability of you being on the right side of the market, right? And by recognizing that trend, we can be proactive and employ a strategic defense of our capital when the need arises. So you want to make sure you have a system that allows you to determine the market's direction. Some people use moving averages on the S&P and other things. I use the guidance from VectorVest. Whatever you do, I suggest you don't listen to the talking heads on TV. Instead, you should have a system which is not emotional, which is based on empirical data, and has an historical track record. So let's take a look at a few of those market moves that we talked about earlier. Let's start by looking at, again, the bursting of the dot-com bubble, just an obvious one to kind of start with. Every Monday through Thursday in our daily Color Guard report and in detail on Friday in our Timing the Market session, we provide guidance such as this. Back on March 17th of 2000, about a week off the peak, we said, Dr. D wrote, I believe that the rally is exhausted. Downside risk outweighs upside potential. Prudent investors should protect profits and take defensive actions such as buying puts and consider any rallies as opportunities to sell stocks at higher prices. That is tremendous guidance. If you were investing back then, would that have been beneficial to know before that sell-off? Let's fast forward to the next big market collapse. This was the housing bubble burst on November 2nd, just days off the market top. We said in our Friday night newsletter, a word to new subscribers, the confirmed down signal that we received yesterday could be the entree to a long bear market. Okay, he went on to say, don't be deceived by the endless parade of experts who will appear on TV and other places telling you it's time to buy stocks. This is not the time to buy stocks. That was right before the financial crisis sell-off. Would that guidance have helped you protect your portfolio? And then let's move to the most recent drop, which just happened last year. Right? And there's been a couple since, but back on February 14th, 2020, just days before the peak, we noticed warning signals in our market timing indicators. So again, our guidance read like this. The price of the VectorVest composite continued to move higher this week, closing at a new record closing high. However, as the price hit a new high today, the BSR closed lower. Okay, to add to that, if we look at a 3-month market timing graph, we can see that the BSR, RT, and MTI closed higher week over week, but they are lower today than they were during the January high. Now, this is what's referred to as a bearish divergence, and that suggests that downside risk outweighs upside potential. Right? Sound familiar? A week later, we said, prudent investors should not buy stocks at this time. Aggressive investors and traders should play the market with a bias to the downside. Again, very helpful guidance that you all should heed. Now that you know what to look for, we need to know how to react. So let's look how to protect your entire portfolio. We call it portfolio insurance. Back in 2018, now this was a sell-off a lot of people forget about. It happened in October of 18. There was another big market drop towards the end of the year. Near the beginning of October, our system signaled what we call a confirmed down call. Now, as a retiree, that's a great indication to become defensive and initiate portfolio insurance. We do that by using a simple option trade that anyone can do called buying a put. So we buy the put on the SPY, which is the ETF that tracks the S&P 500, and that is our insurance policy. The value of a put option will rise when the value of the underlying asset is falling. So if we had gone out and bought 3 put options, right, there's a theoretical trade, it would have cost $600 per contract or $1,800 of insurance to protect a theoretical $100,000 portfolio. Right? This is your asset. This is the insurance policy that helps to offset any damage to your asset. And what happened? Well, we know what happened. The market sold off back in 2018. Now, if you had held it to expiration, your puts would have had a profit of just under $12,000. Right? But even if you didn't hold it and you had closed the trade out here, you still would have mitigated that drawdown tremendously. Your insurance policy helped to offset the damage to your assets. Now here's a more recent SPY hedge that I did, again, for our Tuesday coaching group that meets every Tuesday. On September 9th, we started to see some red lights in the color guard, and I decided to go out and buy a couple of SPY at the money puts, and it was just 2 contracts. They filled them 1 contract each for $7.72. 11 days later, I sold one of those contracts at 17 and a quarter. The market seemed to have found its support, and I sold the next one that I had at 15 and a quarter. So it's an average price of 16 and a quarter. It's $1,700 insurance payout on just 2 contracts in that 2-week period. So just a small indication or illustration of how insurance can help you when strategically placed. So how much would that have benefited you during the prior market collapse? So the strategic shift here is that you need to go from worrying about what could happen and being unprepared when it does, to where you have a strategic defense system in place which protects your hard-earned assets. Which brings me to the next P. And our second P we're talking about is profit. Right? Now that you have a strategic defense system in place to protect your assets, you no longer have to be ultra conservative when investing. Instead, you'll be able to take full advantage of the market upturns to grow your portfolio. In the past, you might have been plagued by buying stocks that didn't go anywhere or were too volatile, causing you to spin your wheels. Well, to fix that, we need to follow the mantra of buying safe, undervalued stocks that are rising in price in a rising market. So for our retirement account, we want to look primarily at a stock safety more so than anything else. So let me jump into the program real quick, and I'm going to illustrate something for you, the power of relative safety. So if I go in to my VectorVest program, I'm going to go ahead and go to the Viewers tab. And what I've done is I've set up a watch list in my program. There's 40 stocks in this watch list, and they're simply kind of random, but not really. They are stocks that you're all familiar with, stocks that where you spend your money, products that you buy, right? Best Buy, Target, Lowe's or Home Depot, right? Apple, Amazon. So I tried to put together a list of stocks that we're familiar with in our everyday lives. They're not just randomly sorted here, though. They are sorted by VST, or the Value Safety Timing Indicator. That's our default sort. But the power of the watch list here lets me go into the relative safety indicator where I can put my cursor there and I can sort these 40 stocks and bring the highest relative safety indicator to the top of the list, of course on a 0 to 2 scale. What I'd like to do to kind of illustrate quickly the power of relative safety is I'm going to take the date on this list back to, and it's not really a random date, it's almost 3 years ago. The reason I'm going back is so we can go through periods of pullbacks in the market. We saw them in 2020 as well, and we can get a good look at some good and bad times in the market. So this is what that list looked like back on January 2nd, 2019. I'm able to go in here and I can quick test. Let's just look at the top 10, right? We're probably not going to go out and buy all 40 of them. But if I quick test the top 10 stocks from January 2nd, basically just under 3 years, we can see that the average value of those stocks, it was up 85% versus the S&P, which is up also about 85%, right? We have about an even move here. Now remember, this does not include any money management techniques or risk management. It's from point A to point B. Okay, most of these are S&P 500 stocks anyway. Now, here's the key though. If I click on relative safety once again, RS is now sorted from the bottom up. Let's quick test these top 10 with the lowest relative safety indicators. And here you can see the dramatic difference, right? Companies you know and are familiar with low relative safety numbers, gather just barely half of what the S&P 500 did over that same time frame. Next, what I'd like to do real quick is go into the stock viewer page, and here we have the 9,000 stocks that we're looking at. As I said, why stick to just the 40 when we have the power of sorting 9,000 stocks by relative safety? So when I click on the RS column, okay, now here they're sorted from the lowest RS. Let me go back to the highest RS here, and I'll go ahead and quick test those top 10 in that same time frame, right? So now we're looking at a basket of the ninth. Well, back then there were, I think, just over 6,000 stocks on the list. Here's what it looked like. So if I were to quick test the top 10 from that point on that day, you see we're up about 115%. That's almost 30% greater than the S&P 500, again, with no money management techniques in place at all. So that's a significant difference when we open up that list or that potential roster of stocks that we see there. And then finally, the last thing I want to show you in the program here is if I were to graph, say, just the top 5 stocks here very quickly, this is the picture of the type of stock that we want in our retirement portfolio. You have the earnings per share rising. You see the price of the stock rising. It's not a coincidence that these have both a northeasterly direction in both price and earnings per share. And you can see the power of the high RS stocks, and that's the type of stock we want in our portfolio. And when we're able to build those portfolios, as I showed earlier, our retirement growth portfolios, we can expect results like this. Now we have in our Tuesday coaching group, we have an actual live money portfolio. We have a 5-position portfolio in place, which began on that confirmed call back on September the 3rd of this year. And you can see it's up over 11%. That's only just about 3 months worth of time. That's actually 50% annualized rate of return. And this is the account where we were able to mitigate the drawdown there by the SPY hedge I talked about earlier. Right, this began as a $45,000 account. That's live money out of $50,000, which I kept free for the ability to hedge to buy put options. So this portfolio from $45,000 is up 11%, or that, I know it's a short term, but it's still, that averages out to 50% annualized rate of return. So the next shift you need to make is to go from slow and stagnant growth to where you have a solid growth portfolio strategy that has you buying good, safe stocks at the right time so you can steadily grow your portfolio. Let's finally go to the third P that we're going to talk about is provide the ability to generate income. There are 2 parts to this. Okay, remember, you don't want to rely on your pension or Social Security to carry you through retirement. So in order to continue to live the lifestyle you deserve, you need to open up some new income streams. There are 2 basic ways to do that. Number 1 is to get paid dividends. Okay, one of the benefits of focusing on quality dividend stocks is they typically pay a very nice percentage to their shareholders, and you want to be able to capitalize on that. Okay, but finding the best dividend paying companies for a lot of people is not always the easiest thing to do. A lot of times folks will either Google stocks or go to other websites, and you'll see the first thing they do is simply sort them by the highest yield, which tells me really nothing about the underlying company or the safety of that dividend. Right? So these are just a couple of examples. In the VectorVest program, we have pre-built watch lists, and I'll start with the DRIP, the Dividend Reinvestment Plan, that stands for. And this list of stocks has not only paid, but has grown their dividends every year for the last 25 years. Okay, and we have very specific dividend indicators and parameters that we use to identify the quality characteristics of the stocks we believe you should have in your portfolio. West Pharmaceutical on this date, just a few months ago, is the top stock on the DRIP watch list. So you have the dividend paid, the yield, the dividend safety is on a 0 to 99 scale, the growth rate, and the yield safety growth vector on a 0 to 2 scale. And so it brings some very good, very well-known companies. T. Rowe Price, Lowe's, Sherwin-Williams has grown their dividend. I think it's 80 or 90 years now. Right, so there's some great stocks on this list, and this is what they look like. Right, West Pharmaceutical, one of my favorites on that list. Goes all the way back to 1995. You can see how they've grown their dividend and how the price of the stock continues to rise. T. Rowe Price, another favorite of mine. When we're able to put stocks like that together, we have the dividend growth portfolio I talked about earlier, and this again doesn't include the dividends. Finally, part two of providing income comes from a very popular, the most popular option income trade out there, perhaps the easiest to execute, is the covered call. It's like collecting rent from the stocks that you own in your portfolio. Let's take a quick look at how the covered call works. Let's say you own a stock, doesn't matter what stock, and it's trading at 176. That's where you own the stock. You already own it or you buy it there. Okay, you own or you buy 100 shares of ABC stock at 176. Here's the most straightforward definition of a covered call that I can give. Someone will pay you money today for the right to take away your 100 shares of stock at a higher price at a specific date in the future. Right? Somebody's willing to pay you to take your stock away at a higher price. Here's what it looks like. Stock's trading 176. Somebody was willing to pay me for the right to take my stock away if the stock trades above $180 per share. And they paid me $10.30 per share, or in this case, $1,033 for one contract. That's the premium that I took in. Well, what could happen? First, we know the risk is inherent in the fact that you own the stock. The profits from the call you sold, though, gives you a nice cushion. And you would still have a stop in place just like you would if you just bought the stock. Now the cushion here is $10.33. At expiration, that stock would have to go down more than $10 before you lost any money. Now the stock could go sideways. That's fine. You get to keep the $1,000, plus you can turn around and sell another covered call against it. And finally, the stock could go up, and that's great because that's when you are able to capture the max profit. You keep the $1,033 and the $4 gain from 176 up to 180 because they're going to take your stock away at 180. So that's just a really quick view of the power of covered calls with the objective of generating income. So ask yourself, how many extra income taps do you have now? And what would that extra income allow you to do? So when you implement the provide piece to your retirement investing model, you'll be able to shift from not having enough income to that steady flow of consistent income, which will allow you to continue living the lifestyle that you desire and deserve. So remember our goals from the beginning: build wealth, transform your legacy, and live financially free. It is possible to take control of your retirement when you have a clear plan. And you don't need to be worried about a market collapse when you have a strategic defense system. That you can see steady growth in your portfolio by using a solid growth strategy. And finally, how you can generate consistent income with new income streams using dividends and covered calls. So that's it. These are the 3 core strategies every retiree must know so that they can retire with the peace of mind knowing that they can grow their capital, generate income, and most importantly, preserve their net worth. When you execute this plan, then and only then will you be able to achieve your goals. So if you are not where you want to be and have no plan to get there, stay with me for just a few more minutes and I can help put you on the right path. Because I do believe you have a choice. You can choose to do absolutely nothing and keep doing exactly what you're doing right now, But the same thinking will just get you the same results. And my fear is that you'll be in the exact same place this time next year or the year after or the year after that, worrying if you'll have enough money when you retire. Instead of taking the long way from here to where you want to be, learn how to take the shortcut. That way you get your retirement on solid footing as quickly as possible. Put in the effort and you will see the results. And it's a simple plan called the Retirement Portfolio Transformation. It's a step-by-step roadmap to a secure retirement. The easiest way for me to explain the course to you is to map it out. Using VectorVest to implement the 3Ps model, the course will guide you through setting up the plan. First, we'll build a strong foundation for your retirement. This is where you'll get a clear picture of your goals and objectives. And always remember, a goal without a plan is just a wish. So you'll learn how to set those goals and to create your vision statement. In Module 2, we'll begin with profit. The profit P, you'll learn how to increase your capital with a safe growth portfolio. Then in Module 3, we'll do the same thing with the dividend growth portfolio. Dividends are a source of income every retiree should take advantage of, but not all dividend stocks are created equal. So the outcome of this module is you'll know exactly how to identify the best dividend candidates. You'll know when to buy them and how to manage them. In Module 4, we'll complete your Provide transformation by teaching you two of our go-to option income trades, the covered calls and selling puts. Now, every retiree needs an additional source of steady, reliable income. Okay? Even if you've never traded options, you'll understand how easy this is to implement. I'll show you how these trades work, when to implement them, and how to correctly set them up and manage them. So at this point, your retirement is set up for growth and income. And finally, in Module 5, you'll learn how to preserve and protect it, which again, to me, is the most important part. All of this is useless, in my opinion, unless you know how to ensure and protect your net worth. Okay, you need to take control, and this module will complete your retirement transformation by teaching you how to preserve your assets. So the retirement portfolio transformation includes the full transformation course I just outlined. There's bonus number 1, our 5 live mastery support sessions that go with each archived recorded module I just walked through. Bonus number 2 is 5 weeks access to my members only group coaching sessions. That's the retirement coaching group that meets every Tuesday. We'll invite you there to see exactly how we implement these week in and week out. The total value of the course along with the bonuses, the retail price would be over $4,300. But if you order before 5 p.m. Monday, which is November 15th, you'll get what we call the early bird special at just $595. Go to vectorvest.com/transform. We'd love to see you with us, and we look forward to working with you. Keep in mind, after the course is over, if you show you've done the work, come to the classes, watch the recordings, and you're still not satisfied, we will gladly give you a refund. So I know there's no such thing as a risk-free trade in the market, but taking this course is risk-free. We're confident that you'll walk away being able to lay that foundation to meet your goals. So ask yourself, how much did it cost you back in 2000 or 2008, 2020 even, by not having this information? Now, if that number is more than just $595, let's fix this once and for all, right? Let's make it so you never have to experience those market collapses ever again. Let's make it so that this year you begin to safely grow your retirement and generate consistent income month after month. So remember, it's time to set your plan in motion so that you can achieve your retirement goals. So thank you for taking the time, and we look forward to seeing you next time.